If you're investing through CMHC-MLI Select, here's something most people completely miss. Your mortgage rates, they don't follow the prime rate, they follow the bond market. And right now, that bond market is already pricing in the rate cuts everyone's been waiting for. That means if your project is closing in 2026 or 2027, you could be locking in financing at rates that are already trending down today. So let's break down exactly how this works, why smart investors are moving now, and why waiting for the Bank of Canada might cost you. Here's the key difference most investors miss. Variable mortgages, the ones dominating the headlines, are tied directly to the Bank of Canada's prime rate. Rate announcement happens. Your rate changes immediately, but CMHC-MLI Select, completely different game. It's a fixed rate product, locked for 5 or 10 years, and it's priced off Canadian mortgage bonds. Think of prime rate as today's weather report. But bonds are the 7-day forecast. The bond market moves based on where smart money believes inflation, economic growth, and monetary policy are headed months and years out, not just today's headlines. So what is that bond market forecasting right now? The Canadian economy is clearly slowing. We're seeing weaker GDP growth, rising unemployment risks, and recession talk everywhere you look. In this environment, global investors pile into safe assets like Canadian government bonds. More buyers means bond yields drop. Meanwhile, inflation is cooling fast. Energy costs are down, consumer spending is weakening, and the housing market is softening. All of this gives the Bank of Canada more ammunition to cut rates aggressively. But here's the key. The bond market already sees this coming, which is why CMHC fixed rates are softening right now, even before the next official rate announcement. And this is exactly why serious MLI Select investors aren't sitting on the sidelines. They're not glued to Bank of Canada press conferences because their financing isn't tied to prime rate announcements. It's tied to bond yields, and those yields are moving ahead of the news cycle. If you've got a multifamily project closing in late 2025 or 2026, you're not walking into uncertainty. You're walking into an environment where institutional money has already started pricing at lower rates. So while the media talks about volatility and uncertainty, the bond market is signaling predictability. That's why smart investors are underwriting deals today, securing financing commitments now, and positioning themselves ahead of the crowd, not chasing after it. So if you've been waiting for official rate cuts before making your move, you're watching the wrong indicator. The bond market moved months ago. And if you're using CMHC-MLI Select financing, that's your signal. I track these exact rates every single month. Canadian mortgage bond yields, lender pricing trends, and MLI Select updates right here on this channel. Hit subscribe if you want this data delivered monthly, drop a comment with any financing scenarios you want me to break down, and check the description for a strategy call if you're ready to run numbers on your next deal. I'm Darren with DK Wealth and Growth, helping you build wealth with real data, proven strategies, and market clarity. See you next week.